Okay. So those who are doing management accounting, you will see that you have some tools that we call the short-term decision-making techniques or tools. So the short-term decision-making tools are something that you are going to use for a decision that is going to be for maybe 2 days, 3 days, or 3 months. It will not take more than a year. That's why we are going to be having the issues with make or buy. You see the make or buy, what you do is that you just want to produce. So you want to know whether you should produce the thing in-house or you should outsource it. You should buy it from someone else. This is something that you are going to, it's a decision that you are going to take for today or maybe for a month. So it's not something that is involving. Okay. But what if you want to buy a car for Uber? Look at the life span of a car. A car can be there for like 10 years. So you see that this is a decision which is going to be involving a lot of money. So how do you go about it? Before you can get the money that you are using to buy the car, it is going to take time. So you can't just stand up and say that, okay, I'm going to buy a car without you looking at the benefit that you'll be getting from the car, or without you looking at how long it is going to take you to get the money from the car that you are going to be buying. So that is why we have what we call the investment appraisal techniques. The investment appraisal techniques is basically used for long-term decision makings. A company wants to make a long-term decision that is so much committed, and that is going to take a lot of money, and that is going to take a lot of time. You can't just stand up and take that decision on your own. You have to critically analyze the decision before you undertake it. And the tools that we use is what we call the investment appraisal techniques or the short-term decision-making techniques. So we are going to be looking at what we call capital budgeting. Capital budgeting has to do with non-current assets. So you having a budget for non-current asset is what we call the capital budgeting. Or you preparing a budget for a non-current asset is what we call the capital budgeting. So the investment appraiser, we are looking at what? Capital assets. What do you call capital asset? Those assets that is going to take a substantial period for them to be consumed. That's what we call the capital assets. So first of all, maybe you can decide to differentiate between revenue and capital expenditure. Okay, revenue expenditure are those expenditures that are on daily basis, maybe salary to workers, discounts allowed, all those things that will be incurred maybe more than once in a year or something that each benefit is consumed in a year is what we call the revenue expenditure. But capital expenditure are those expenditure that will not be consumed in a year and something that will happen once in a while. So maybe extension to a building will be recognized as a capital expenditure. So the investment appraisal that we are going to be looking at, we are looking at capital decisions. We are looking at capital assets. If you want to buy a plant that you are going to use for 5 years, what are the things that you see before you buy the plant or you will not buy the plant? The tools that you are going to use to evaluate whether you have to buy the plant or not are what we call the investment appraisal techniques. All right. First of all, what you have to know is that you are going to be doing this for what? For a profit-making organization. So for a profit-making organization, the company can only undertake the project if the project is going to end up increasing the shareholders' welfare. If it's going to maximize the shareholders' welfare, fine, you can take that particular decision. And the tools that we use is the investment appraisal tools. But if you come to the public sector, like the non-profit making organization, the motive of the project is to improve the social welfare of the citizens. So it doesn't matter the amount of money. If the government wants to undertake a project and they realize that the project is going to benefit a lot of the citizens, the government will go ahead to undertake that particular project. So for investment in the public sector, it's not about the investment bringing a positive return. The investment bringing a positive result on the citizens. Is it going to have a greater impact on the citizens? If it is going to have a greater impact on the citizens, we can go ahead with that particular decision. Like the free SHS is something that is going to happen for a long time. So they have analyzed it and said that, okay, this is going to benefit a lot of Ghanaian citizens. So let's undertake it. It doesn't matter the amount of money they are going to use. But if the project is going to improve the welfare of the citizens, the government will undertake the project. But for profit-making organization, the project should be having a positive what? Return. The motive is that the project must what? Maximize the welfare of the shareholders. Okay. If you come to public sector again, the tools that we use is the what? Is the 4 E's. The value for money. The tools that we use is the value for money. So we try to see whether the project is going in accordance with the principles of value for money. So we use the principles of the efficiency, the effectiveness, the economy, and the equality. So that is the investment techniques or the tools that they use for appraising the projects. All right. So let me take it again. I'm saying that investment appraisal that we are going to look at over here. We are going to look at a company want to undertake what? A capital what? Investment. A capital investment means a project that is going to last for maybe 5 years. You can see that this is going to be involving a lot, and this is going to make the company to be committed for 5 years. You can't just stand up and take that decision. You can only take the decision if the decision is going to give you a positive result at the end of the project period. So if you want to buy, assuming you want to buy a car for Uber, a car will last for maybe like roughly 10 years or something. Okay, you can't just stand up and say you are going to buy the car for the Uber. No. You first have to ask some people who are what? Who are already in the business. So you first have to ask the people who are already in the business. So you ask them, okay, how much are you people getting a day? Or a year, how much are you people getting? Okay, this is the amount of people you are getting a year. So if I'm using 10 million, if I'm using 10 million to buy the car, and every year I'll be getting 2 million. Okay, how long is it going to take me to get my money? If the cost of the car is 10 million, but every year I'll be getting a cash flow or a return of 2 million, how long is it going to take me to what? To get my 10 million? How long is it going to take me to get my 10 million? Auntie Bridget, how long is it going to take me to get my money? Auntie Douglas, can you hear me? Sina Sharif, can you hear me?
Yes, please. Linus.
Yes, I can hear you.
Okay, if you can hear me, answer my question. I'm using 10 million to buy the car, and they are telling me that at the end of every year, I'll be getting 2 million as cash flow. I'll be getting 2 million as the cash flow. How long is it going to take me to get my 10 million? How long is it going to take me to recoup the investment?
5 years.
5 years.
Okay, so the 5 years, you now ask yourself, if I should use this particular amount of money for something, it is going to take me 4 years to what? To get my money. So will I be buying the car, or I'll go and use the money for something that will be giving me the 10 million in 4 years' time?
I think I'll invest in the 4 years time soon.
Okay, so you can see that you are appraising or you are evaluating the investment using the number of years that the investment is going to take you to give you your money. So one of the tools is the payback period, where we look at how long is it going to take me to recoup my investment. So if I should put the money in a bank, in 4 years' time, I'll be able to get my 10 million. But if I'm going to buy a car for Uber, it is going to take me 5 years. So it means that I will not buy the Uber. I'm going to put the money in a bank. I'm going to buy a deposit in a bank. So one of the tools is what we call the payback period. Okay. Another tool that we use is also, you ask yourself, okay, the investment that I'm going to be undertaking, what is the return in terms of percentages? What is the return that I'll be getting at the end of every year? So you find a return on the investment. Okay, so if I'm using 10 million, but every year they are saying that I'll be getting 2 million. So the money will be for 5 years. Okay, the money will be for 5 years. So I can decide to find a return that I'll be getting on this. I'll have 2/10 times 100, and that will give me 20%. So if I should invest the money into the Uber business, in terms of percentages, the return that I'll be getting is 20%. But if I put the money in a bank, the return that I'll be getting every year is 25%. What are you going to do? Will you buy the car or you go and put the money in the bank?
I'll put it inside the bank.
All right. So you put the money in the bank, isn't it? All right.
Yes.
So another method that we use is the accounting return. So you ask yourself, what is the return that the investment will be giving to you? You compare to what a different project. If you are putting the same money into a different project, what is the return that it will be giving to you? So you compare and see if the return that you'll be getting on the investment is higher than the one that you'll be getting from if you should go and put the money elsewhere. That is why you decide to go whether you should invest or not. So one of the tools that we use is the payback period, and we also use accounting rate of return. Okay. Someone can also tell you that the money that you'll be getting, the cash flow that you'll be getting at the end of every year is 2 million. And this amount, you are going to be getting this amount for 5 years. Then you ask yourself, am I undertaking the decision today? Am I undertaking the decisions today? So if I should receive all these 2 million that I'll be receiving at the end of every year today, what will be their present value? So you are undertaking the decision today, which is 10 million. So if you want to make decision, you have to compare today's value that you'll be getting to the cost that you are going to be spending. So you ask yourself, the 2 million that I'll be getting at the end of every year, if I should have them today, what would be their value? So you find the present value of all the cash flows and compare with this one. So one of the appraisal tool that we use is what we call the net present value. The net present value, which is the NPV. Another one is, okay, the cost of capital that you are using. Okay, you want a cost of capital that is going to give you a zero profit. Okay, the question now is, what is the actual cost of capital? Maybe because of time value of money, you are going to be using the cost of capital to appraise the project. Okay, you are using 8%. You want to ask yourself, using the 8%, is the 8% going to give you a profit? Or is the 8% going to give you a positive return? Okay, if the 8% is going to give me a positive return, which rate is going to give me a zero profit? Okay, so if the rate that is going to give you zero profit, you don't want to make any profit, the cost of capital that should give you a zero profit is 10%. It means that, okay, you can use the 8% because the 8% is going to give you a higher return. If the rate is higher, if the rate is low, the cash flow will be higher. If the rate is higher, the cash flows will be low. So you ask yourself, the rate that you are going to be using, for one, we are going to base our decision on the discount rate. The payback period, we base our decision on the investment. For the accounting rate of return, we base our decision on the investment. For NPV2, we base our investment on we base our decision on the investment. But another tool that we call the internal rate of return, we base our decision on the discount factor. So we ask ourselves, the discount factor that we are using, is it going to give us a positive return at the end or a negative return. What we do is that we just look for a rate that is going to give us 0 profit. So if the rate that we are using is 8% and the rate that is going to give us a 0 profit is 10%, then we can say that based on the internal rate of return, we should undertake the project because 8% will give us a higher cash flow than what? The 10%. So we also have another tool that we use there as the internal rate of return. The last one is what we call the discounted payback period. The discounted payback period is just a time value adjusted what? Payback period. The normal payback period does not take into consideration time value of money. The discounted one will take into consideration time value of money, but the calculation will still be the same for all the two. But just that the cash flows that we use is discounted, we discount the cash flows and use it for the discounted payback period. We also use another tool that we call profitability index. That is where the company is having a lot of investment and the money that they have is not up to that one. So they will now choose between the combination of the investment that they should undertake. So basically, we'll be looking at 5 of them. We look at the payback period. If you want to buy the Uber, you ask yourself, how long is it going to take you to get your money back? If it is taking you like 10 years, you say that, okay, 10 years is too long. That time, the business might fall. So I will not undertake this particular project. You look at the return that the project will be giving you in terms of what percentages. You compare with what the return that another project will be giving you if you put the same amount of money into that particular project. Then you will now see whether you should make the decision or not. So that is just the intro of the investment appraiser. Let's get into it. Let's look at the steps involved. So they have asked this question before. The steps involved in what? Capital investment decision making. Okay, they have asked this question before. I'm sure that will be maybe March or something. Maybe they ask them in March. The first one is you should identify the investment opportunities. You can't just stand up and say you are going to undertake an investment. No, you have to get the investment. You have to identify what you are going to do before you decide whether you should put money or you should go ahead with it. So maybe where you are staying, if the people want to, in terms of transport, if the people want to get to the roadside or before they can go to the next town, they have to walk. So what do? You have identified opportunity right now. So, okay, if I should get a motorbike or if I should get a car, I'll be able to be transporting or to be conveying people from one region to the other one or from our place to the other town. So that is the investment opportunity that you have identified. You have realized that people normally walk from your village to the other town, which is going to be very stressful. So if you should get a motorbike or a car, it is going to help them. That is the opportunity that you have identified. So after you have identified the opportunity, what you do now is what we call idea screening. So you now gather information on the investment. So the opportunity now is you want to buy a car. People have been walking from your village to the other village. So you want to get a car or motorbike. Then you ask yourself, what are the things involved? If you want to get a motorbike, what are the things that you have to do? Or you want to know more about this particular investment? What is the risks involved? You can be riding in the night or driving in the night. The armed robbers can attack you and take the motorbike for you. So you have to gather information on the investment. What are the side effects and what are the side benefits of this particular opportunity? So you go further with the idea. You can even present it to experts that they should look at it for you and see whether it is going to be profitable or not. Okay, the next one is after gathering this particular information, screening the information, then you now analyze and evaluate this particular investment. So the analyzing and evaluating has to do with the money. What is the amount of money involved in the project? What is the amount of money involved in the project? So this is the amount of money involved. What is the cash flow? So the analyzing and evaluating has to do with the monetary side. How much do I need to put over here? So the cost of the investment is 20 million. how much will I be getting at the end of every year? If I buy fuel and those kind of things, how much will be left after incurring all the necessary expenses? How much will be left? Okay, the money that I have compared to this one, how many years is it going to take me to get my money back? So you can decide to use the payback period. You can decide to use the accounting rate of return. You can decide to use the net present value. You can decide to use the discounted payback period. You can decide to use the internal rate of return. So this is where you'll be appraising the investment with the investment appraisal technique tools. So you have to appraise the investment, take the cost, take the amount involved, take the cash flow that you'll be getting. Then you try to appraise the investment with the appraisal tools and see whether this investment is worth undertaking. So if you see that this particular investment is worth undertaking, it is going to give you a positive return using the NPV. It is going to take you a shorter period to pay back this particular, or for the project to pay back. Then you can now approve the investment by saying that, okay, I'm going to buy the motorbike or the car. Then you buy the car. So if you buy the car, are you going to be driving the car yourself? If you're not going to be driving the car yourself, then it means that you have to be monitoring and see if the person is bringing the amount that you are expecting at the end of every day or at the end of every year. So that is why we monitor and see whether the investments, the people are carrying out the investment as planned or they are doing their own thing. So these are the 5 steps that you have to undertake, or you have to look at before you undertake any capital investments. They have asked before and they will continue asking, and they will ask. That was March. They asked them that they should state the stages in the investment, in the capital decision-making process. All right. Okay. All the investment appraiser techniques, we are going to be using cash flow. It's only accounting rate of return that we don't use cash flow. We use only profit. So for all the investment appraiser techniques, we'll be using cash flow. Which type of cash flow will we be using? We will be using relevant cash flow. So those who have done relevant costing, in management accounting, that is what we'll be using over here. So we'll be using relevant cash flows. If we are talking about relevant cash flows, we are talking about cash flow that should be incremental. Okay, if you're looking at fixed costs, what will be the increment in the fixed cost if you decide to undertake this particular decision? Okay, you have a car park that you are currently renting for 2,000. So you want to buy a new car. Now the rent is 2,500. You can see that you are now paying an additional 500 as a result of you buying the new car. So the incremental cost over there is the 500. And that 500 is the only cash flow that is relevant to the decision that you want to undertake. Because if you don't buy the old car, there is no way, even if you don't buy the new car, you will still be paying the 2,000. So even if you don't buy the new car, you'll be paying the 2,000. So what is the additional cost that you are incurring as a result of you undertaking the new decision now? Is 500. So that is what we call the incremental cost. So what will be the additional cost that you are going to be incurring if you undertake the decision? That is what we call the incremental cost. We also look at what we call future cash flows. We look at future cash flows, and we also look at what we call the variable cost. The variable cost will always be the labor and then the material. Okay. We also look at what we call opportunity cost. Okay. If you undertaking this particular project, is it going to affect some of your existing operations? If you undertaking the project, is going to help you not to be using 200 of the labor hours for your existing product, which you are getting a contribution of 20 cedis per hour on it. The 20 cedis per hour now, which is a contribution, which is a lost contribution, will be seen as opportunity cost because you are sacrificing that particular labor hours for the project. So we use future cash flows. We don't use what cost that has already been incurred. You have carried out a research on the project, and the cost has already been incurred already. Research costs are treated as sunk costs or past costs. We use future cash flows that you'll be will be incurring or will be arising in the future as a result of the decision. As a result of the decision. So we use relevant cash flows as we are going, then you'll be looking at what we call the relevant cash flow. So let's look at, I want us to look at the basic method, which is what we call the payback period and the accounting rate of return. Then maybe next week, Friday, we look at the net present value and the other ones. So let's look at the payback period. I've explained the payback period already, and it's one of the basic method, payback period. So the first one that we can use is the payback period. The payback period is the time that it is going to take you to recover your investments. So the number of time that is going to take the project to pay back is what we call the payback period. So what you have to do is, if you are going to undertake a project for 20 million, at the end of every year, the project is giving you 20 million. You see that it is going to take you 5 years to get the money. How do you calculate the 5 years? It is going to be the initial investment over the annual cash flow. That is 5 years. Okay, so it is going to take you 5 years to get your money back. That is what we call the payback period. The 5 years is the payback period. Okay, the payback period can be calculated in 2 ways. We have one of the cash flow that will be constant cash flow. So if your cash flow is constant, how do we calculate the payback period? So let's look at the payback period. So the payback period, we have the constant annual cash flow. Constant annual cash flow. The constant annual cash flow, our payback period, is calculated as the initial investment. The initial investment over the annual cash flow. The constant annual cash flow is where you are going to be receiving that amount of money at the end of every year. So if you are spending 20 million now, and every year you'll be getting 2 million, your payback period will be calculated as 10 million over 2 million. That will give you 5 years. Okay. This can also be calculated like this. We can also calculate this one using this particular one. So the payback period, we also use a format like this, which we have the years, we have the annual cash flow, or we have the cash flow. We have the cash flow. Then we have, let's say we can call it the balance. Okay. Or you can also have accumulative cash flow and also the balance, but that is not a problem. Me, I'll normally put the balance here at once. Okay. So we have year 0, which is now. There is nothing like year 0. But we assume that cash flows arises at the end, or cash flow arises at the end of every year. So if you are doing it now, the year 1 is at the end of the year. So if you are starting now, we just assume that now is year 0, because year 1 will be 31 December. Year 1 will be 31 December. So if you are undertaking the project now, we say that that is year 0, because you are going to be counting year 1 at the end of the year. Now it is January. So we say that the year has not started yet. So we say year 0. But there is nothing like year 0. Now means year 0. So now, today you are going to be spending 10 million. Okay, that is an outflow. That is the money that you'll be spending. Okay, year 1, you'll be getting 2 million. What will be the balance? You have 10 million. You are spending 10 million. And at the end of year 1, you are getting 2 million. What will be the balance? What will be the balance on the amount of money that the project will be owing you?
8 million.
Okay, so you'll be having 8 million. At the end of the second year, you will still be having 2 million. What will be the balance?
6.
Okay, that will be 6 million. You'll be having 3 million. What will be the balance? Year 4, you'll be having 2 million. What will be the balance? 2 million. Year 5, you'll be having 2 million. What will be the balance over here? 0. So it has taken you how many years to it has taken you how many years for the project to pay back? So the project pays back
5 years, sir.
at the end of the 5th year. So the year that you are going to be having a zero cash flow, that is why we say it is at the end of that particular year that the project has paid back. The payback period can also be calculated as, okay, we can say that, okay, it has taken us 4 years, okay? In the 4th year, how much is needed for the project to pay back? It's 2 million, isn't it? How much is needed for the project to pay back? It's 2 million, isn't it?
Yes, sir.
Okay, what is the cash flow for that particular year? What is the cash flow for the 5th year?
2 million.
2 million. Okay, so we can see that, okay, we need a balance of 2 million to pay back, and we have 2 million. So we can see that this is the same as 2 million over 2 million, because this cash flow over here is for the full year. We need a balance of 2 million to pay. Okay, so what portion of this cash flow relate to the balance that will pay back? That will be 2 million over 2 million, which is a full year. So we do 2 million over 2 million times maybe 1 or 12 months. That will give us 5. So we have the 5 years. So the payback can also be calculated like this. You have your prior year to the payback, then you have your balance for the project to pay back. Then you have the cash flow for the year in which the project pays back, the total cash flow for the year that in which the project pays back. So let's come to an even cash flow. An even cash flow. Okay. If you have an even cash flow, it means that the cash flow will not be the same at the end of every year. The payback period is calculated as what I have done over here. The prior year, so it's equal to the prior year to the payback plus the balance for the project to pay back before the project pay back over the annual cash flow in the year in which the project pays back, multiplied by 12 months or multiplied by 1, which will be a year. So you can find it in a year or in this one. So let's look at it. Let's look at the years over here. So let me just use this example. Let's have the years here. So the years over here, then I'll have my cash flow. Then I'll have my balance. Okay, so let's assume that year 0, we are still spending 10 million. So we are going to be having a balance of 10 million. Okay, year 1, we are getting 3 million. What will be the balance? That will be 7 million. Am I correct? Okay, year 2, we are having maybe 4 million. What will be the balance? 3 million. Okay, year 3, we are having 2 million. What will be the balance? 1 million. Okay, year 4, we now have 5 million. So what will be the balance over here? The balance will now be positive 4 million. Okay, the balance will now be 4 million. The question is, look at this. In which year did the project pay back? Or how long does it take the project to pay back? Is it up to the 4 year? Is it taking us 4 years, or is it going to take us 3 years and some months? Is the project taking us 4 years to pay back, or is it going to take 3 years and some number of months?
3 years and some number of months.
Okay, you can see that we only say the project has paid back in the full year if the balance is 0. But you can see the total cash flow for the 4th year is 5 million. We need only 1 million out of this for the project to pay back. So if you want to find your payback period, you can see that you have already done 3 years, but the project has not paid back. So you have your 3 years. Then you now ask yourself, we need 1 million in the 4th year for the project to pay back. But the total cash flow for that particular year is 5 million. So this 5 million is for 12 months. So how many months is going to give us the 1 million that we need? That's what we do. So if 5 million is equal to 12 months, 1 million will be equal to what? So we do 1/5 times 12 months. And that will give you the number of months that it has taken us to get the 1 million. Okay, so we have the 3 years plus 1/5 times 12. What are we getting? I'm getting 2.4 months, isn't it? So you can say 3 years and 2.4 months. So that is how long it has taken you for the project to pay back. That is how we go about it. But if the cash flow is even, the payback period is calculated as the initial investment over the cash flow. Let's pick some questions on cash flow. Or before we go, the payback period, we use cash flow. Okay, it's very important. Payback period, we use cash flow. Sometimes the question can give you profits after depreciation. Profit after depreciation. Okay, they can give you profit after depreciation. We are using cash flow. It means that we assume that they have taken the depreciation from a cash flow and they are now having profit after or profit after depreciation. So what we do is that you add back the depreciation to the figure given to you as profit after depreciation. So add back the depreciation to the profit after depreciation, and that will give you the cash flow, because depreciation is a non-cash item. So just add it and have your cash flow. Or sometimes they can give you the annual cash flow. Then they will now give you, because the cash flow that we use is after tax cash flow, not pre-tax cash flow. We use after tax cash flow. So they can also give you depreciation, and they also give you a tax rate. Okay, you know that the company is going to be enjoying some tax on the what? On the depreciation. Depreciation will be allowable for tax purposes. So you have to separate your depreciation from the cash flow, or separate your depreciation from the profit. Then you charge the tax. Then you now come and add the depreciation back. We will look at that one if we are doing net present value. But you have to know that for payback period, we use cash flow after tax. We don't use profit, we use cash flows. Let's pick a question and we see how we can go about that particular question. Hey, I'm not having payback period question. I don't have any question on payback period. Oh, let's end there. Okay, let's look at the question 6. Who is reading for us? Question 6. Who is reading?
A company is both proposals are for similar products and both are expected to operate for 4 years. Only one proposal can be accepted. The following information is available. Initial investment. Estimated scrap value at the end of year 4. Depreciation is charged on straight line basis. Required. A. Calculate the annual cash flow for year 4 for proposal A. B. Calculate the payback period for both proposals and advise management. C. Calculate the return on capital employed on average investments for both proposals.
Okay. So let's look at this, and they are asking us to do calculate the annual cash flow for year 4 for proposal A, and the payback period for both proposals and advanced management. Calculate the return on capital employed on average investment for both proposals. This one we are here to do this one, which we call the accounting rate or return. Okay, let's look at this one. You can see that you are giving profit or loss, isn't it? You are giving profit or loss, isn't it?
Yes, please.
Okay.
Yes.
How do you determine the profit? The profit we have taken into consideration depreciation, isn't it? We have taken into consideration depreciation for each of the products, isn't it? Okay.
Yes.
Yes,
Okay.
please.
All right. So we assume that since we don't have any other items over here, we assume that the only thing that is going to be a non-cash item is the depreciation. So let's come to question 6. So let's find a depreciation for each of the proposal. Okay, depreciation will be calculated as a cost minus what? The scrap value divided by the useful life. We use, if nothing is said, we use what? The straight line method. Let's see whether the question is saying that they are using straight line method. So depreciation is charged on a straight line basis. Okay, so what is the cost? The cost is the initial investment, which is 46,000. The scrap value is what? 4,000. Okay, so our depreciation will be 46,000 minus 4,000 divided by how many years? Okay, that would be
4 years.
okay. So how much are you getting? I'm having 10,500, isn't it?
$10,500.
Okay, our annual depreciation is 10,500. Okay, so if you want to get cash flow, what do? We add a depreciation to the profit, isn't it?
Yes, please.
So let's get the A part, the annual cash flow. Depreciation is subtracted from the cash flow because before we get a profit. So what we do is that we add the depreciation back. We add the depreciation back. So the profit for that year, you can see that year 4, they have a loss, isn't it? Year 4, they have a loss of 1,005, and the depreciation was 10,500. So what should have been the cash flow? What should have been the cash flow? What should have been the cash flow before? If you subtract the depreciation from it, you'll be getting a loss. So what will be the cash flow? What should have been the cash flow? Okay, so the annual cash flow will be the profit.
12,000.
Are you sure? If you subtract 10,500 from 12,000, you're not going to get loss, or you get profit of 1,005.
Okay.
So the cash flow is supposed to be 9,000. So you are going to be having 1,500, which is negative, plus 10,500. And that will give you 9,000. So the cash flow for that year is 9,000. But if the profit over there is not a profit, it's a loss. So if it's a profit, that is why you have the 12,000. But a loss, so it will be negative 1,500 plus 10,500. That will give you 9,000. So the cash flow was 9,000, and we have subtracted the depreciation from it, and we are now having a loss of 1,500. So you add the depreciation back to the cash flows. So that is the A part of the question. Let's now come to the B part, which is the payback period for each of the projects. So we have to find the cash flow. Payback, we use cash flow. We use after tax cash flow, but we don't have tax over here. We don't have the tax rate over here. Like we have the tax rate, we'd have adjust this thing to get our cash or after tax cash flow. Okay, so let's do it for proposal 1. Let's do it for proposal 1. Then we see what we do. So let's come to proposal 1. Proposal A. So we are going to be having the years, the cash flow, and the balance. Okay, so we have year 0, which is now. How much is the cost? How much are we spending? It's 46,000.
46,000.
Okay. Year 1, what will be the cash flow? Let's see whether we are following. What will be the cash flow for year 1, proposal A?
17,000.
Exactly. That will be 17,000. We add the depreciation to it. So that will be 17,000. What will be the balance?
29,000.
29,000. Okay, let's come to year 2. What is the cash flow for year 2?
$14,000.
Okay, it will be 14,000. Okay, so year 2 will be 14,000. What will be the difference? 15,000. Okay, year 3 will be what?
Yeah, 3.
Year 3 is what? Is it 24,000?
24,000.
Okay.
24,000.
What will be the balance?
That would be positive 9,000.
Okay. So this one, we are only looking for the payback, but you can do the full year. What will be the cash flow for the 4th year? It will be 9,000 plus what? You see that the scrap value will also be a cash flow. You'll be receiving the cash flow at the end of the 4 years. So it's also part of the money that you'll be receiving. So we add the residual value to the actual cash flow, and that will be 13,000. Okay. That will be 13,000. So that will be 9,000 plus what? The 4,000. That will give you 13,000. And this will now give you 22,000. But we are not interested in this one. We are interested in the number of years that it has taken us to what? To recoup the money. So let's look at this particular calculation that we have did. Okay, the calculation that we have done, sorry. In which year do you think the project pays back? In which year? In which year do you think the project pays back? It will be
year two and part of year 3.
so it will be 2 years and something months, isn't it?
Yes.
Okay. So you take your what? You have already done 2 years and the project has not paid back. Okay, how much do we need in year 3 for the project to pay back? How much do we need in year 3?
6,000.
No. How much do we need in year 3 so that the project will pay back in year 3 or will pay back at the end of year 3?
15,000.
We need 15,000, isn't it?
Yeah.
So we now have 15,000. But what was the total cash flow for year 2? For year 3 rather?
24,000.
Okay.
For
so
year
this
2 or 3?
year 3.
Now 24,000.
Okay. We need only 15,000 out of this for the project to pay back, isn't it?
Yeah.
Okay. But this 24,000 is for 12 months. Then you ask yourself, what month will give you 15,000? So you do 15,000 over the 24,000 times 12 months. What are we getting?
8 months, 7.5.
Okay, so I'm getting 2 years and 7.5 what? 7.5 months. Am I correct? Okay, so this would take us 2.5 years, so 2 years, 7.5 months. Okay, so that is what for that one. Let's count to proposal B. Okay, proposal B, we have the years, we have the cash flow, then we have the balance. Okay. Please, the advantages and disadvantages, you can look at it over there. Have the balance, which some people call cumulative cash flow. I don't have any problem with that. Then we have the cash flow itself. Okay, so year 0, you see that they are all having 46,000. Okay, so you can see that this project, we can compare them. Some projects, they will be having different investments. So sometimes you have to compare. It doesn't make sense. One is having more capital than the other. It will be very difficult for you to compare. Okay, so this one, they are all having the same investment, the same depreciation. Year 1, what will be the cash flow for year 1? Cash flow for year 1 will be what? Would that be 15,000? Is it going to be 15,000? Senior, is it going to be 15,000? 4,500 plus the depreciation. The depreciation will be the same for the two. Depreciation is the same for all of them. So 10,500 plus 4,500, 15,000 minus 46,000. The balance will be 31,000. Okay. Let's now count to year 2. Year 2, what will be the cash flow? What will be the cash flow for year 2? Proposal B. Are we here? 13,000. Okay, thank you. So the cash flow will be 13,000. What will be the difference? Okay.
18,000.
Year 3, what will be the cash flow for year 3?
15,000.
It will still be 15,000. Okay. So 15,000. What will be the balance?
3,000.
Year 4. What will be the total cash flow for year 4?
29,000.
29,000. It will be more than 29,000. 14,500 plus 10,500 plus, okay, it will be 29,000. So the normal cash flow is 25,000 plus the 4,000 scrap value. Okay, 29,000. What will be the difference here? 26,000, isn't it?
Yes, sir.
Let's find the payback period. So you can see that we have already done 3 years before the project pays back. The project pays back somewhere in what? In year 4. So we do plus 3,000 over 29,000 times 12. What are we getting?
1.24.
Okay. So we are having 3 years.
1.24 months.
1.24 months. Okay. So which of these projects are you going to be advising them to undertake? A or B?
A.
Okay. Because the A is paying back, is taking 2 ends. So A will pay back before the B, isn't it? Okay. This one, you only give advice that if the company they don't have the cash to undertake the 2 projects, then they should take the A. But look at this one. What is the cash flow at the end of the project? What will be the net cash flow at the end of the project? It will be 22,000, isn't it? For the A, it is going to be 22,000. Am I correct?
Yes.
Okay.
Yes.
For B, how much is it?
26,000.
But which project are we recognizing?
You are recognizing A.
But you can see that at the end of the day, proposal B will be giving them enough what? A net cash flow at the end of the year, at the end of the what? The project than what? Than the A. But we are recommending what? A, because A will pay back before B. So one of the disadvantages of the payback period is that it doesn't take into consideration cash flows after the project pays back. After the payback period, it doesn't take into consideration those cash flows. If we should take after the payback period cash flows into consideration, we should be recognizing, we should be recommending what B. So one of the disadvantages of the payback period is that it doesn't take into consideration the cash flows after the payback period. So if you look at the 2 projects, you see that the project B is more viable than what project A. But since we are using a payback period, we are taking A because A will pay back than what B. By the end of the project, B will be giving them more return than A. So payback period does not take into consideration cash flows after the payback period, and it doesn't also not take into consideration time value of money. You can see that year 1, we are doing this calculation at the time that we are undertaking the project. How on earth can you say that the cash flows at the end of the year will be the same as the cash flows now? You are doing this calculation now, and you are saying that, okay, from now to the end of the year, the 15,000, the same value that 15,000 will be having today, the same value 15,000 will be having at the end. The same value that 13,000 is having today, the same value 13,000 will be having at the end of the second year. No. There are certain things that is going to make the value of money to fall. So the payback period does not take into consideration time value of money. Those are the 2 of the disadvantages that I can tell you. The advantage is that it's easy to calculate and understand, and it's widely used by most companies because it's the simplest one. It's the simplest one. It can also help you to identify what investment opportunities, because if you look at this particular project, is going to take you a longer period. It means that the project is not it's not good. It's not good. So we use those ones to do with those cash. Okay, so we use the payback period. This is how we use the payback period. It's not anything. Sometimes a question can give you certain items that you should determine the cash flow yourself. We will get there. If you are doing net present value, you will get there. So don't worry. Let's look at what we call the accounting rate of return. So this is payback period. Let's look at what we call the accounting rate of return. Okay, let's look at what we call the accounting rate of return. Accounting rates of return, which we call the ARR. Okay. As far as FM is concerned, they haven't examined the payback period before. But the accounting rate of return have been examined once. Net present value, that is the side that the examiner likes most. And the internal rate of return, so they have examined that one. Discounted payback, so they have examined that one. Lease or buy, they have examined that one. But they are here to examine sensitivity analysis. Last sitting was the risks, where they will ask you to find the expected values, which was a very simple one. And they are also here to examine the asset replacement decisions. So we don't know what is going to happen. The net present value is always the preferred one. Okay, let's come to what we call the accounting rate of return. Okay, the accounting rate of return, what we do is that, okay, if we should put this particular money into the business, what is the profit that this particular project will be giving to us? So we just find a return on capital employed. So if we should put the money into the project, or we want to use this money to start a business or to start any project, what is the profit that we'll be getting from this particular one? The profit that we use is after depreciation profit after depreciation. So what will be the return on the investment? What will be the return on investment? Okay, so if you are investing 10 million into a project, okay, and the project is giving you 2 million now. So what will be the return in terms of percentage? What is the return on the investment? It will be 2 million over 10 million times 100. So that will give us 20%. So the question now is, if I should invest my money somewhere, I will be getting 25%. So I will not invest in the business or in the project, then but I will invest it somewhere, because it will be giving me a higher return than what I will be getting. So you just ask yourself, if you should put the money into a project, what will be the profit? We use after tax, after depreciation, what profits? After depreciation profit, not after tax profit, after depreciation profit, because the investment is going to be an asset that is going to what? Consume over time. So as soon as you are using it, the efficiency of the asset will be reducing. So we charge depreciation against what? Against the profits that it will be getting. So we find the profits, but what is going to happen is that mostly it is a capital investment. It is a capital investment. It is a capital investment. Since it's a capital investment, it's going to take more than a year. So you'll be giving the project for 5 years. You can't just find the rate for each of the years. No, you are finding the return on the total investment. So the best way that we can find the investment is that, okay, let's total all the profit for the year. Then we find average. So we use average profits. We use average profit to find the rate of return. So accounting rate of return is calculated as the average profit, or average profit after depreciation. Average profit after depreciation over average investment. The question can tell you average investment or initial investment. The examiner can define it for you, how you should calculate it. But if nothing is said, then it is average investment. The question now is, how do we find the average profit after depreciation? You take your profit after depreciation for each year, total it, and divide it by the number of years. That is the profit after depreciation. But how do we find the average investment? That is very important. Okay. Average investment. average investment is calculated as the initial investment plus the scrap value over 2, then plus working capital. If you have a working capital, then you add, so all of this divided by 2 before you add the working capital to it. Okay, that's how you find the average investment. So you add your scrap value to your initial investment, then you now find your average investment. If you have a working capital, you add it. But if you don't have scrap value, it will still be the initial investment divided by 2, because the scrap value you add, you just put 0 there. You just put 0 there. So this is how we go about it. How do we find the average profit? You total all the profit after depreciation, then you now what? Find the average divided by the number of years profit that you are adding. That's how we go about it. Okay, sometimes the question will give you profit before depreciation, profit before depreciation. How do you go about it? It depends on the method that the company is using. So they can give you a profit of 20 million, which is profit after depreciation for 5 years. Okay, then they will now give you the initial investment, which is the cost. Okay, they can give you initial investment of 200,000. And the question can give you a scrap value of 40,000. Okay, they can give you a scrap value of 40,000. It means that the depreciable value will be 160,000. So you can also find your average profit like this. So your average profit, you can find a profit for the 5 years, which is profit after tax, that will be 20,000 times 5. So you'll be having 200,000. Okay, the question now is if you are charging the depreciation for every year. If you are charging depreciation for every year, it will be 160 divided by 5. So every year will be like 160 divided by 5 will give us what? 160 divided by 5 every year will be 32,000. So every year 32,000. Every year will be 32,000. But you can see that every year 32,000 for the 5 year will still give you the 160,000. So you can find your total profit for the 5 years. Then you now come and subtract your depreciable value. Your depreciable value, which will be the depreciation for the 5 years. That will give you 160,000. Because every year is 32,000. And the profit over here is the profit for the 5 years. So the depreciation for the 5 years will still be the 160,000. So you'll be having a profit of 40,000. So for you to find the average, you divide it by 5. And that will give you 8,000. So you have your 8,000 as the average profit. So your accounting rate of return will be 8,000, which is the average profit divided by the average investment, which will be 200,000 plus the scrap value, 40,000, all divided by 2. And that will give you 120,000. Then you multiply by 100. This particular thing that I've done over here works for only straight line method depreciation. You see that straight line method, the depreciation is going to be fixed for every year. Depreciation is going to be fixed for every year. So we can just find the total year's profit and we subtract the depreciable value. Let's pick a question, 2 questions on that and see. Let's take a 2 years question on that and see. Let's pick 2 questions on that and see how we can go about it. Okay, let's look at question 28 and the last question. Let's take the 28 first. Who is reading up for us?
Question 28.
Yes, please.
Sakamagana Limited uses the accounting rate of return, ARR, as the basis of evaluating projects for investment of its scarce financial resources. It uses its predetermined expected return on capital as the basis for the choice of investment projects. The company's finance team has provided the information below regarding various projects and their initial investments and net cash flows. The hurdle rate or target accounting rate of return of Sakama Ghana Limited is 25%. Required. A. Calculate the accounting rate of return for each project. That is average investment basis. B. Using the target return of 25%, advise Sakama Ghana Limited which project should be undertaken.
Okay. So all right. So that is what we have before us, and they say we should advise the we should advise them. Okay, let's look at the investment now. Take note of this. What's the figure given to you over here? What are the figures given to you for each year?
Net cash flows.
Okay, but the accounting rate or return, what do we use?
Profit after depreciation.
Okay, so the net cash flows, is this, are they taking the depreciation out of it? Is depreciation taken out of these figures?
No.
No, because this is cash flow. Depreciation is a non-cash item. So depreciation has not been taken out yet. So if you subtract depreciation from it, then you have your profit after depreciation. Okay, let's now look at how can we calculate the depreciation. Nothing was said about if the depreciation is calculated on a straight line basis or what? Or reducing balance basis, isn't it? Okay, so what we have to assume is that depreciation will be calculated on the what? On the straight line basis. We are not giving any scrap value. Do you have scrap value here? Do you have scrap value?
No.
Okay.
No.
So what will be the total cash flow? It means that at the end of the year, depreciation for project A, for the 4 years, depreciation for project A will still be as the initial investment. Do you agree? For the 4-year period, the depreciation for project A will still be as the initial value. Okay, because annual depreciation will be what? 1 million divided by 5. Am I correct? Okay, that will give us how much? It's divided by 4, right?
200,000.
It's divided by 4. Look at the project A. It's up to only 4 years. Okay, so that will give us 250,000, isn't it? Okay, so it means that we have to subtract 250,000 from here, 250,000 from each of them. So 250,000 over here, 250,000 over here, 250,000 over here. You can see that for the 4 years, we have subtracted the same 1 million. So let's go about how do we find the average profit for the first project. Okay, let's look at the average profit for the first project. So accounting rate or return for the A is calculated as the average profit divided by average investment. The question says that you should use average basis. So average investment multiplied by 100. Okay, let's look at how do we calculate the average profit. Okay, our average profit for A will be calculated like this. Okay, so you look at profit. Each year, you look at the profits, the total profit. So you have year 1. What is the cash flow for year 1? Can someone mention them? 600, 500, 400, 300. Okay. So year one is what? 600. Year two is 500. Year three is it 400? And year four is 300. Okay. These are all profits before depreciation. So you have to take the depreciation from it. The depreciation will be the full value, which is 1 million. So what will be the profit for the total year? So what will be the profit for the 5 years? What will be the profit? I'm getting 800,000. So if you want to find the average, what do? We divide by what? 4, isn't it? So that is the profit after depreciation for the 4 years. You find the average. The average will give us 200,000. Okay. Another way of you finding the average profit, alternatively, is that you can find your profit after depreciation for each year. Okay. So you look at the years over here. So we have the year one. Our profit after depreciation will be 600,000 minus 250, because depreciation every year is 250. That will give us 350,000. Okay. Year two will be 500,000 minus 250. That will give us 250,000. Year three will be 300. Okay, will be 400 minus 250. That will give us 150,000. Year four will be 300 minus 250, because annual depreciation is what? Is 250. So that will be 50,000. You can see that at the end of the day, you will be getting 800,000. So this 800,000, you find average, because this is a profit for the 4 years. So you find average by dividing by 4. Then you now get your 200,000. So anyhow you want to do it, we don't have any problem with that. All right. So let's look at the accounting rate of return. So our average investment, our average accounting rate of return will be average profit, which is 200,000. Okay, divided by 500,000. Am I correct? Average investment, 500,000. Is that correct? Average.
Yes.
Okay. So what will be the answer now? What will be the percentage? What will be the percentage? 40%. Is that correct?
Yes, 40%.
Okay, let's look at B. Accounting rate of return can be calculated as, okay, so someone can also find this one straightforward without wasting time. Okay, since we understand, we know how to do the first one, we can do the second one. Okay, so we have 700 plus 600 plus 500 plus 500 plus 400. So the total profit before depreciation is 2.7 million. Okay, so I can have 27 minus what? The initial value, which will be the total depreciation for the 5 years, 1,600. So I have 1,600. So I'll just do this one divided by 5. Then I'll have the average investment. The average investment will be 1,600 divided by 2. So someone can you can do it at the top like that and get your answer. You don't have to go and show any working, because this is mathematics divided by 5. I'm getting 200,000 divided by 1,600 divided by 2. That will give us 800,000. So I'm having 220 divided by 800 times 100. I'm getting 27.5%. Okay, so you come to the C2, your accounting rate of return. You can also apply the same principle to that one. So we have 800 plus, what will be the total profit for the 5 years? 600 plus 500 plus 400. Okay, that will give you 2,300. So 2,300, 2.3 million minus what? The total depreciation for the 5 years, which will be the same as the initial value. That will give you 2,000. So 2,000 all divided by 4, because this project, the lifespan is only 4 years. So this will also give you 2,000 divided by 2. Okay, this will give you divided by 4. Okay, that will be 75,000 divided by 1 million. What are we getting? I'm getting 7.5. Is that correct? I'm getting 7.5. Can someone confirm that? Can someone confirm that?
Yes. Yes, 7.5.
Okay.
Yeah, 7.5.
So using the target return of 25%, advise Akama, Ghana Limited, which project should be undertaken? Which project should they undertake? The target rate is 25%. So which project should they undertake? You can see that the first one is giving us what? A return of what? 40%, isn't it? The second one is giving us 27.5. So this one is giving us 7.5. This one should not be undertaken at all because okay. So this one should not be undertaken at all because the return is lower than their target return. But this, the B and the A, their return are more than what the target return. But the question is, does the company have the money to undertake the two projects simultaneously? If yes, then they should go with A and B. But if no, then they should go with only the A because A is giving more return than what? The B. A is giving 40% and B is giving 27.5. Although the two projects are viable, but since the company will not be having money to undertake the two simultaneously, they should go with what? 40. So don't just go there and say that the company should undertake the 40. No, you can see that their target return is 25. Any project that is having a return more than 25% is considered what? Viable. So the question now is, if you have three projects that is having more than 25%, the question is that the company have the money to undertake all the three at once? If no, then you now recommend the one with the highest what? Return. So I was saying that if you look at the question that we have calculated, okay, so I was saying that if you look at what we have calculated, you can see that Okay, if you look at what we have calculated, project A is giving us 40%. Project B is giving us 27.5. And the target ARR is 25%. Okay, you can see that the two of them, they are having a target more than 25%. So the advice is that the A and B are what? Are project that should be undertaken by the company. But the question is, does the company have the money to undertake this project at once? Do they have the money to undertake all of them at once? If yes, then they should go ahead to implement the two projects. If no, then they should go for the one that is having a higher what? Return. So you can't just stand up and say that the company should go with what? The 40%. No. The company can have money to undertake the two projects. If they have the money, they should go with the two, because the two is giving a return that is higher than what? The average what? Return. But if the company is not having the money, or the two projects are mutually exclusive, it means that they cannot be undertaken at the same time. If one is undertaken, the other one will have to be what? Have to be forgone. Or if the two of them are independent what? Projects which they can be undertaken simultaneously. If they have the money, they should undertake the two. Or sometimes the question can say that the two projects are independent. It means that they can be undertaken at the same time. Or they can say the two projects are dependent. It means that you can undertake this one and forget about the second one. The two of them have to be undertaken at once. Dependent means that before you can complete project A, you have to undertake project B. Before you can complete project A, you have to undertake what? Project B. You can't achieve what you want to achieve if you undertake only one of them. So if you want to give the advice, you first look at the resources that the company is having. If they can undertake the two at once, they should go ahead with the two. But if they cannot, they should go ahead with the one giving them the highest what? Results. Okay, let's look at the last question. Then we know that we are done with the basic issues. So we know that we are done with the basic issues. All right, question. Question 33, who is reading for us?
The following projects are being considered for investment using the accounting of return. Depreciation is on straight line basis with useful life of 5 years for both projects. Required: A. Advise on the most profitable option. B. Explain 3 demerits of accounting rates of return.
Okay. So this is an MA question for last sitting. So since I don't have enough, all my questions are on the advanced what investment techniques. Okay. So I have to bring this one here. Okay. So what method is the company using? You can see that is what? They are using accounting rate of return, isn't it? Okay. Let's now come here. Let's now come here. We are giving profit before what? We are giving profit before what?
Depreciation.
Depreciation. So we are solving question 33. Okay. So let's look at project A. Which method are we using for the calculation of the depreciation?
Straight line.
Straight line. So what we do now is that what will be the residual value for project A?
65,000.
Okay, what will be the depreciable value? What will be the depreciation for the 5 years? What will be the total depreciation for the 5 years? Okay. So let's look at year 1. What is the profit before depreciation for the project A? That is 42,000. Okay. 2 is 92,000, isn't it? Year 3 is what? 100,000. Can someone mention those figures for us fast? 88,000 and 82,000 final. And 82,000 final. What will be the total profit? And what should have been the depreciation? The depreciation would have been a total depreciation, which will be the depreciation, total depreciation should have been 360,000 minus 65,000. That will be the depreciable value. Then we do over 5 years. So it means that at the end of every year, we will take the depreciation there. But since we are totaling the total profit, it means that we just find the depreciation also on total basis. And that will give us 275,000. So we have 275,000. So let's find the total profit for 92 plus 100 plus 88 plus 82. I'm having 404,000. Can someone confirm that? Okay. So what will be the average profit now? The total profit for the 5 years will be 129,000 divided by 1.
Hello.
Yeah. Can you hear me?
Yeah, please the cost.
Hello.
The investment cost is 340.
We have a scrap value. Please, are you using earpiece? Because your son, you are giving a bad signal. This thing is giving a bad this thing that I cannot. Let's look at the investment cost here. The cost of the asset is what? 340,000, isn't it? Okay. 340,000. Our scrap value is what? Is 65,000. So annual depreciation will be 340,000 over minus 65,000 divided by 5. What will be the annual depreciation? What is the annual depreciation? Is it 55,000?
Yeah, 55.
55,000 for the 5 years. Every year is 55,000. So what will be the total depreciation for the 5 years? Would that be 275,000?
Yes, 275.
Which is the same as the what? The cost minus the scrap value. So we just find the depreciation. We can't go and be subtracting the depreciation from each of the profits one by one. You see that if you subtract, at the end of the day, total depreciation will still be the same as the depreciable value. So just find the scrap value for the 5 years. The depreciation will be 55,000 times 5. So this is the profit that we are totaling for 5 years, profit before depreciation. It means that since we are doing for 5 years, we have to add the depreciation also for 5 years and take it. And that is why we have the 275,000 over there. So if you I'm getting 25,800, is that correct? The average profit is 25,800, is that correct?
Yes, please.
Okay. What will be the average investments? The average investment will be 340,000 plus 65,000 all divided by 2. Am I correct? Average investment 340 plus 65. Average investment is the initial investment plus the scrap value, all divided by 2 plus working capital. But we don't have working capital here. So I'm having 202,500. Is that correct? So our accounting rate of return for the first one will be 25,800 divided by 2,500 multiplied by 100. Am I correct with that? Are we here?
Yeah, we are here.
Okay. So what are we getting?
12.74.
Okay. So let's calculate our this one. Let's count to average profits. Let's calculate our average profit here. So the average profit, what you do is you just find a profit for each year. So total the profits. So the years, so we have the year 1, year 2, year 3, year 4, year 5. What is the profit for each of the years under the second one? We have 68,000, 85,000. So we have 68,000, 85,000. The third year is what?
90,000.
Okay, 90,000, 80,000, and 80,000. Okay, what will be the total profit for the 5 years?
403,000.
Okay. Okay, 403,000. What will be the total depreciation for the 5 years? It will be 290 minus the scrap value. What is the scrap value?
240,000.
Okay, that will be 240,000. So 40. The scrap value is 50. So that will give us 240,000. All right. What are we getting? I'm getting 163.
163.
Okay, the average profit will be divided by 5, isn't it?
Yes.
So after getting this answer, you divide it by 5. So divide by 5. 3 to 600, isn't it?
Yes, please.
Yes.
Okay. So let's find our average investment. I hope we can get the average investment straightforward. Someone can also decide to subtract the depreciation from each of them. You'll be getting the same answer at the end. Depreciation each year is 48,000. 48,000. So you can do it like this. You'll be getting the same answer at the end. But I don't have that time. Okay. The
Average
average
investment.
investment will be what?
170,000.
Okay. So 170,000. All of this multiplied by 100. What are we getting? I'm getting 19.18. 19.18. Is that correct?
Yes.
Okay. Which of the investments should they undertake?
Project B.
They should undertake the B. But you can see that the advice that you are giving is to some extent is not valid. Look at the investment in each of these items. You can see the company, how much are they investing in the A? The investment in A is 340, isn't it? Okay. The investment in B is what? Is 290. How can you compare an investment which is having a capital outlay of 340 to 290? The comparison doesn't make sense. Okay. The meaning is that this one, the one with the higher capital outlay, will be having a higher what? Initial investment. So if the initial investment is higher, your percentage will be low because the denominator is the one that is going to have a greater impact on the what? On the answer. If the denominator is higher, it means that if your numerator is low or is not that high, you'll be having a less amount. Okay, look at this one. You can see that this is 32,600 against this one. There is no much difference, but the difference between the average investment is the one that is having the greater impact. But in the exam, they should go for the one with the highest what? Accounting rate of return. That would be B. So the company should implement the what? The project B because it's having a higher average rate of return of 19.18 compared to 12.74. But this one, maybe you can also you can also leave that particular limitation there. This comparison cannot be done because they are having a different outlay, though they are having different useful life, but their capital investment is what is different. But in the exam, they should go for what the project B. Okay, so this is about the basic ones. So I want us to finish by 8:30. So I will just talk about the NPV. So the NPV, what we do, the NPV, we consider time value of money. So if I'm investing 10 million today, if I'm investing 10 million today, and you are telling me that I'll be receiving 2 million every year for 5 years. Okay, I know that the value of 2 million at the end of each year will not be the same as the value of 2 million now. There will be an issue with what? Inflation and other issues. So I have to consider time value of money. Okay, so the meaning is this 2 million over here that I'm receiving at the end of the year. What is the today's value of this? The 2 million I'm receiving in 2 years' time. What is the today's value of this? So I'll find the today's value of all the cash flows that I'll be receiving. Then I'll compare with the amount that I'll be receiving. So I know that the 2 million that you are saying that I'll be getting at the end of every year will not be the value of it today, will not be the same as the value of the 2 million in the time that you are saying I'll be receiving that particular amount of money. So what should have been the actual value of the 2 million today? What should have been the actual value of that 2 million today? So I'll find the present value of that 2 million, or I'll find the present value of all the cash flows. Then I'll just compare with what? With the amount I'm investing, because I'm making the decision today. So what is the today's value of the amount that you are telling me that I'll be receiving? Let me get it, let me total it and see whether it is higher than the amount that I'm spending. If it is higher than the amount that I'm spending, then I have to undertake the project. But if it is lower than the amount that I'm going to be what? Investing, then I should ignore the project. So that is how the time value of the NPV works. And the NPV, internal rate of return, discounted payback, they all what? Depend on the NPV. Doing this all after these two basic methods, all the methods that we are going to be looking at, all the issues that we are going to be looking at are all dependent on what? On the NPV. So if you don't know how to calculate the NPV, you are going to have a lot of issues, because lease or buy will be on NPV. Asset replacement decision will be on NPV. Risk and uncertainty, which is the sensitivity analysis and probability issues, are also going to be on NPV. Internal rate of return will be an NPV. Discounted payback will be NPV. NPV itself is based on the NPV. So all the remaining things that we are going to be looking at in this particular lesson will be on the NPV. So the NPV, you have to take our time and get it. So I won't touch it right now. I want to do the normal NPV, where you will not have issues with working capital, you will not have issues with taxation, you will not have issues with capital allowance, you will not have issues with what? Inflation. But I won't touch that one right now. Friday, we do the normal NPV with the issues of the working capital, inflation, taxation, and also capital allowance. Then the next week, Sunday, we look at the complicated issues, sensitivity analysis, lease or buy, and asset replacement decisions. All right, thank you, seniors. If you don't have any question, I would like us to end it here. Okay. You have to know that at the end of the lesson, at the end of the session, we are going to do a mock again. So the mock that we did the last time is just a pre-mock. The final mock will come, and we are going to be using the pre-mock and the final mock for the revision. All right. So that is that, and I'll see you guys.